Should we, as Canadians, Torontonians more specifically, care about the bank implosions in the US that happened over the weekend? Is this a repeat of 2008? Maybe yes, maybe no. So we're going to talk about that in this video. We're also going to talk about how those bank implosions affect mortgage rates here in Canada as a result of how consumers are reacting to the news of those banks imploding. And we're going to talk about the US CPI numbers that were released this morning, March 14th, 2023. Just came out. Some good news, some not so good news. So we're going to dig into it and talk about it. 158 weeks in a row we've been doing this. This is week 158. March 2020 is when we started. And today it is March. Oh, wow. It's almost the 3-year anniversary of this blog. So thanks so much for all your subscribers, Real Estate Raccoons, and the Spring team. And don't get it twisted. This market report is awesome, and I spend a lot of time on this, but I also run a team of 14 agents. The Spring team is one of the most active and successful teams in Toronto real estate. We are about to open an office on the West Coast as well. So aside from this report, we also are high-level realtors who sell, buy, invest. We help landlords, we help tenants. So please reach out if you have any needs there. And also your subscription is very much appreciated. So let's get into this right now. Let's talk about Silicon Valley Bank, Signature Bank, and interest rates. So last weekend, we had Silicon Valley Bank, SVB, basically go completely belly up. Why did they go belly up? May not be for the reasons that you think. They had made some investments. They required to make up a huge $20 billion deficit. So in order to do that, they issued some stock, which devalued their company by like 60 or 70%. They still ended up with a $1.8 billion loss. But that scared a lot of the tech companies because Silicon Valley Bank is focused on the tech industry in Silicon Valley. So a lot of venture capitalists sent out this email, Peter Thiel more specifically, sent out this email to all of the companies that he's invested in, millions and millions and millions of dollars, and told them to start pulling their money out of SVB. But of course, banks are not as liquid as you might think, and they weren't. So then there are no regulations to protect these regional banks because, well, during the previous US administration, all of the regulations that were put in place to protect people from this sort of scenario were removed. So this regional bank was basically running unregulated, exposed to a little bit more risk. They didn't have enough cash to meet the demand of their clients who are requesting their money. So here we are today. But the good news is the federal government stepped in, protected every penny of the deposits from all these companies. So payroll still happened and things like that still happened. But what happened there was people got scared. And when people get scared, they take their money out of riskier investments and they put them into safer investments like government-backed bonds, which is why what's happening there is directly tied to our mortgage rates here, specifically fixed mortgage rates. And not to get too deep in on this topic, you can read more about it on the blog, which is linked below if you're watching this on YouTube. When people run to bonds as a safer investment, just like anything else, as demand increases for something, the price of it also goes up, which means that the yield is reduced. And our fixed rate mortgages are directly tied to bond yields. So as bonds get more expensive, their yield is reduced, which essentially puts downward pressure on our fixed rate mortgages, but only if those bond yields are sustained, the lower bond yields are sustained for a period of time. So as early as this week, we could see a temporary reduction in some fixed rate mortgage products because, like I said, all of this activity and these fixed rates are based on the 5-year Government of Canada bond. So as the yield on those decreases, our fixed rate mortgages should decrease. So it might be a good idea to lock into some sort of fixed rate product if you are not comfortable with any sort of volatility with variable rate mortgages. With the way things are going right now, we're like jumping from one unprecedented event to another, COVID being the main unprecedented event. This one, I wouldn't call it unprecedented. We've seen this kind of economic turmoil before in the financial world. We saw it in 2008. That's why some certain regulations were put in place to prevent this kind of disaster in the States. But here we are with a similar situation. Signature Bank, another bank that imploded over the weekend, was more focused in the crypto world. But again, they are going to be fine. Overall, we are going to be fine as well. But the short-term result of all this is fear. So, but that doesn't seem to be affecting Torontonians that much, because every single house that we have shown our clients at the Spring Team is going into multiple offers, regardless of the quality of the home. But of course, the location does still matter. Not every single home that's out there is getting this kind of attention, but it seems like every single home that we are showing is getting this kind of attention. Maybe our clients just like really good things that other people like. I don't know. But so let me look at the blog here to make sure I'm not missing anything. So good. So the good news is that the U.S. government did protect the deposits of all of these tech startups and established tech companies, so payroll can still happen. So that trickle down effect of people defaulting on things like their loans and mortgages and rent is not going to happen. But I mean, I don't think the crisis is totally averted yet. I don't believe that this is, but I also don't believe this is just the beginning of something here in Canada. There are a lot more protections for our financial institutions here. Some Canadian banks did have some exposure to this to some of these implosions, but just like in 2008, the exposure was limited, and it's not at the point where we should be worried about what's happening to Canadian banks. But I certainly would worry about the short-term future of our economy, because like I said, we're going to talk about the US inflation numbers, and I talk about the US so much, and I've been paying so much attention to the US because essentially what they do, we do. We've been very much their, brother or sister in this whole scenario. If they increase rates, we kind of follow suit. I mean, it's just, we have to manage and kind of thread the needle managing the value of the loonie at the same time, because if everybody's running to the US because they're able to offer higher rates on their government-backed securities, then our loonie gets kind of devalued and it props up the US dollar. So they kind of have to thread that needle there. So we do have to follow suit with what they do. But the silver lining to all of this for the short term is that this increased pressure on bonds would essentially eliminate the likelihood of a big 75 basis point increase to the US overnight lending rate, which was what was predicted to happen. People were saying a 50 basis point or a 75 basis point increase at the next US announcement. I think their March 22nd is their announcement. So that pretty much takes that off the table, which is good, because although we did hold rates at our last announcement on March the 8th last week, the expectation was that we were likely going to have some sort of increase after the US did their big increase on the 22nd. Because, although we've been going off script a little bit and not following what they've been doing, I think it would be foolish to not kind of do that at the next mortgage announcement here in Canada. So what that means is we're probably likely going to hold our rates again in April and then see how that progresses into the summer. But the US inflation numbers, which I was talking about a moment ago, came in generally positive, down from 6.4 to 6%, which is fine. I mean, it's fine, but when you really dig down into it, still food got more expensive, and housing got more expensive, but energy came down, and the used car market definitely has been affected as supply chains kind of figured themselves out after that disastrous time during COVID. So I think that there's a lot of positive news there, but also cautious news. I think some people would like to say we're in some sort of deflationary period right now, which is true technically, but when you look at the actual cost of running your home every day, that got more expensive. So consumers and people like you and I are feeling the pinch at home at the grocery store with prices of food up over 10% year over year, etc. But looking at June and the U.S. inflation numbers, they were 9%. So being down at 6% right now is a step in the right direction. I just think that people are a little too optimistic about inflation hitting that 2 to 3% range here in Canada and in the US within 2023. I just don't see how that can possibly happen. It would be an incredibly dramatic drop. And if that does happen, fantastic, but I just don't see a realistic scenario where 2023 sees any sort of, first of all, major mortgage rate decreases in the variable world, especially. Because that's going to be directly tied to what happens with inflation. But again, in Toronto, buyers don't seem to give a shit. I mean, they're still out buying. They're buying with big numbers with February 2022 kind of activity. So it's a very interesting time in Toronto right now. And I really, is it that people don't know what's going on in the world or they don't care? Facebook announced today they're cutting Meta announced today they're cutting a further 10,000 jobs after the 11,000 jobs they already cut. But then, as we talked about last week, there are a lot of small and medium-sized companies that are in hiring mode. So it's a very interesting time in the economy that I don't believe that the events that are triggering these things are unprecedented, but the reaction to these things seems to be unprecedented and a little less predictable. So anyway, inflation seems to be moving in the right direction, a lateral move in some cases, and like I said, food and cost of living is gone up. Cost of housing has gone up from sales to rentals. So it's a very interesting time out there that I'm really excited that I'm digging deeper and deeper and understanding the whole, bigger picture of how these things happening around the world are affecting us here. But it also gives me a lot of comfort and understanding that there are still so many things that Toronto has that are keeping us from melting down like some less popular cities that are more affected by things like this. Toronto still does have record immigration. And it's not just because, like, Toronto is cool, let's go there. It's because we have great jobs with companies that are still hiring. Like, tech companies in Toronto seem to still be hiring. So that's good. We have amazing healthcare here in Canada, and hopefully that stays. We have so much industry here, from film. Like, I don't even want to talk about this anymore because I sound like a broken record, but there's too many things to keep people here and to want more people to come here for our real estate to be somehow devalued to the point long term where it could affect you if you bought today. So I just feel like there are buying opportunities in every market, and if your financial situation allows you to get into the market, you should. I have yet to see a scenario where somebody with long-term vision has lost in the city. You can fight me on that or not, but like, it's just so hard to think another way because I've just seen too many people get too wealthy from investing in Toronto real estate, regardless of where the market is. And forget about wealthy and investing. Toronto is just an awesome place to live. So like, why wouldn't you want to live here? Like, that makes no sense to me. Fine, in the winter, like, get me the hell out of here in the winter. That's cool. Get me to freaking Bahamas where my good friend lives. Get me to wherever else that is not snowy because I can't stand the snow. But overall, Toronto, I couldn't think of living anywhere else, and many other people feel the same way. So let's get that day trader mentality out of your heads, but it's also really important to understand all of this information so you can feel good about the things you are doing today. Make sure you're getting your information from people that know what they're talking about. If you are wanting to invest in condos, speak to current condo investors, not to those that bought in the 90s that are, telling you, oh, things are too expensive today. If you want to buy a multi-family building, talk to people that currently invest in multi-family buildings, not some guy who bought a place in 1980 for $100,000 that says, oh, that's way too expensive today, I would never buy it. You have to get with the minds of the people that are doing the things that you want to do and doing it successfully. All the rest is just noise. If you're following creators in any of the social space that are just putting out an article and being like, what are your thoughts? That's just anxiety-inducing bullshit. Help understand follow people that are helping you understand the context of what's going on and what it means to you. Likes, views, and shares are great, and it seems like a lot of these anxiety-inducing creators get that, and I'm now getting more at peace with that because the information that we're putting out on Real Estate Raccoons is real, it's relevant, and it matters to you as Torontonians and Canadians today. I'm not just saying all this stuff because when you buy, my team makes a commission. That is 100% true. But we don't want just one deal from you. We want to work with you for the rest of your life. We want this sale, this purchase, and the 50 million other ones that come along from you and your family because we are so good at what we do. We're so deep in the weeds in the data that I can't imagine being served by any other agent other than a Spring Team agent. Too many underserved clients in this city. So please reach out and let's talk about this some more. Really love your comments. Let's keep that stuff going down there. And I'll see you next week in week 159. And don't forget to subscribe. Bye.